So, Mr. Secretary, give us, if you can, a rough sensitivity analysis on the question of the trend line growth, because you said it depends critically on investment in things like infrastructure and tax policy, which seem to be linked up. What's the upper level? What's the lower level, depending on what they do there? What do you expect in terms of trend line growth for the United States over the next 5 years?
Well, I can't comment on 5 years, but I would say clearly in the foreseeable future, I mean, we could easily see 6 to 8% growth. I think the other area, and the previous panel commented on this, is the risk of inflation and how that plays out. Now, inflation is good for certain parts of the economy and very bad for other parts of the economy. So I do worry, as Larry Summers and others have said, that the chances are higher as opposed to lower, that this is ongoing inflation and that the Fed will need to adjust for that. I think in the interim, there'll be businesses that are growth businesses, high margin businesses with consumer spending that will do very well with higher inflation, and businesses with lower margins and high costs of labor are going to be concerned. So I think the inflation outlook is something that's going to need to be managed very carefully.
Well, let's talk about managing it carefully, because it appears that the Fed is coming around to the view that at least has to be concerned about inflation. That's what we heard from the Fed after the FOMC meeting. We heard Chair Jay Powell say we're paying attention now to inflation, even though they didn't take specific action. Do you think that what the Fed is doing, basically in indicating down the road they're going to have to tighten some, do you think that that's going to be enough to rein in the danger of inflation?
Well, I have a lot of confidence in Chair Powell, and we worked obviously very closely over the last several years. Clearly, what the Fed did last year during the pandemic really helped, and it was critical. So there's no question that the Fed needs to go into a period of normalizing rates and normalizing the portfolio. And I think the question is really how quickly they do that and how they do that in an effort to control inflation. I think the issue is that the Fed is being cautious. The Fed models, the Treasury models, economic models really are not very good at predicting, given the vast amount of fiscal and monetary response we had over the last year. So I think this is something that needs to be watched very carefully. And I do think the markets are underestimating this risk.
Well, it does raise the broader question, at least for me, of how much of the growth we're seeing right now, because as you say, Mr. Secretary, we're going to see some robust growth this year in all likelihood. How much of that is because of the fiscal and monetary support as opposed to the underlying strength of the economy?
Well, I think a large part of that is going to be the fiscal and monetary that allowed for the reopening of the economy. So again, I just want to put this in perspective. Over a year ago, I never thought I'd be in a period of time sitting in an Oval Office talking about shutting down travel to Europe, talking about shutting down the entire economy. So there's no question that now that it's reopened, and now that, at least in the US, there's vast vaccine distribution, you're seeing businesses come back very strong. And I believe in particular the travel, entertainment, leisure business, people like these videos, but people want to get back out and travel and see people.